Good day, my name is Papa. Today I'd like us to go through the financial analysis or analysis of the financial reports. The topics that we will cover will be made up of the following. What do you do with the financial reports? Why must you analyze the financial reports? And the techniques and ratios that we use to analyze those reports. Examples to give you a sense of comfort of how these ratios and techniques are applied in your business. And lastly, we'll go through the questions to gauge and assess the amount of knowledge that you've gained from these topics above. Let us start with the topic of what do you do with the financial reports? There are two things that we do with the financial reports. One, we analyze them. Secondly, we make decisions based on the results of those analyses. Why must we analyze the financial reports? One, for every business purpose is to make it a point that we are able to determine whether a business is making a profit or not, or is it maximizing its profits or not. Secondly, we need to be in a position where we are able to ascertain whether the interest and long-term loans of the business are being repaid successfully. Thirdly, every business will have its short-term liabilities or its short-term debts. We need to make it a point that we also can service those debts or be able to repay those debts. 4, we need to establish that the investments that we make in the business, either in the form of capital, either in the form of equity, and so forth, will be able to give us fair and acceptable returns. It should be able to give us returns that will make us as a business sustainable. Fifth, the analysis should be able to indicate to the business the areas that are underperforming. In instances where those areas have been identified, there should be also a platform to identify the causes to the problems identified. Lastly, the ratios or the techniques need to evaluate the ability of the business to pay its personnel or other benefits that are due to the personnel. I want us to go through a 6-step approach that I wish to suggest so that you have got a more coherent and a systematic analysis of your financial reports. Those 6 areas are made up of the following. 1, you need at all times be clear what is your purpose of analyzing the financial reports. Secondly, so that you are able to identify the techniques and ratios that are suitable for your business, you have to have a good overview of what your business is all about. Thirdly, you need to choose the techniques that are necessary and that will be useful for your business. Number 4, without any accurate information from your accounting systems, your analysis is bound to give you the wrong conclusions or the wrong analysis and wrong decisions for your business. So it's imperative that your accounting system is able to produce accurate and reliable information so that your conclusions and decisions can be as accurate and reliable. Number 5, you need to have a comprehensive analysis. You need to give yourself an opportunity to look at analysis comprehensively covering all areas necessary for your business. You need to avoid a myopic view where you only look at analysis in silos. Number 6, which is last, you need to make decisions. It's pointless for you to go through all the 5 steps of analysis and at the end of the day do not make decisions as a business owner. This is a graphic illustration of those 6 steps. Let's look at the first step, where you do the selection of what tools or techniques are relevant for your business, where you look at what's the purpose of the analysis and what are the appropriate tools that should be used. Second to that, you do have to have comparisons. You need to compare within the entity or other entities. You need to compare from one year to the other, or one period to the other. And thirdly, you need to look at the industry that your business is operating within. And 4, you need to look at the budgets, which will be able to determine whether your performance against the target set or the objective sets are met or are not met. Thirdly, on your comparisons of the techniques and tools that you have selected, you need to evaluate. When you evaluate, you need to look at the results, whether your results are favorable or negative. You need to look at the expected, which is the reason for poor performance, and the sustainability thereof. And lastly, as you evaluate, you've got to have a sense of accountability. You need to be in a position where you can tell who or what is responsible, especially where there is underperformance. And lastly, you need to also, as you work out on the areas identified from your evaluation, be in a position to predict as well. You need to be able to predict whether your actions taken to correct are going to have what effects into your business. Having gone through the background information on analysis of financial reports, including the steps that should be taken so that you could have a systematic approach on your analysis, I'd like us to focus on 2 elements of analysis of financial reports. 1, I want us to focus on profitability analysis, and secondly, I want us to focus on liquidity, cash, and working capital. The reason I want us to focus on these 2 areas, these are the areas that I have identified that for a small or emerging businesses, they are very necessary and they are very relevant for that environment. Let us look at profitability analysis. 1, we will look at gross profit. What is gross profit? Gross profit is the profit that is directly derived from sales or from revenue. What's the formula for gross profit? The formula for gross profit calculation is sales minus cost of sales. And this figure should always be expressed in terms of rand values. Secondly, I want us to look at the net profit. The net profit is derived from the following formula. The formula for net profit is gross profit minus operating expenses. And this as well must always be expressed in terms of rand value amounts. Thirdly, I want us to look at a gross profit margin. The formula for gross profit margin, it's your gross profit that you have derived from this formula. You divide that with the sales, and this has to be expressed in terms of percentages. And net profit is derived from the following formula, which is net profit which you have derived from this formula, divide by the sales, and the results of this must also be expressed in terms of percentages. The last one, return on assets before interest and tax. Why I want us to look at return on assets in addition to the for-profit analysis is because as a small business, you will be from time to time be challenged with the acquisition of assets for the purpose either of starting your business or growing your business. It becomes critical at that point that you are able to tell how much value are you yielding from those assets in terms of generating revenue. You wouldn't want a situation where you have got idle assets. And this formula is the best formula that can show you whether are you keeping idle assets or you keeping profitability assets. And the formula thereof is made up of the following. It is net profit divide the total assets as shown in your statement of assets and liabilities. And the results of that also must be expressed in terms of percentages. So the results of these formulas must always show you a positive sign. If the results show you a negative sign, you should be worried because that is an indicator of poor performance. Secondly, as you do your comparisons, you should always have a situation where the result is the increasing or is the growing. When your comparison shows an increase, that will show that you are in a better situation. So in summary, the results of the two, because I want you, when we start with the examples, you are able to make a cohesion between the formulas and the results. First, if it's positive, it's good performance. If it is negative, it's poor performance. And the higher the profitability or the percentages of those results, the better for your business. Let's look at the example. This example is a statement of profit and loss. It's a statement of profit and loss because it shows us the sales, it shows us cost of sales, it shows us the profits, it shows us expenses. And this profit and loss report, it's for 3 months period. It's for January 2016, it's for your February 2016 and March 2016. Now I want us to use that report to determine the areas that of profitability that I've spoken to you about. Remember, those areas are 1, gross profit, 2, it's gross profit margin, 3, it's net profit, 4, it's net profit margin, and lastly, it's return on assets. Now let's look at this report and see how we apply those formulas. Let's go, for example, in the month of January 2016. In the month of January 2016, should we be asked to determine the gross profit of the company? We can see the gross profit of the company is 39,973,722 rands. How did we arrive at that? You can see it's a formula, as I explained to you previously, sales minus cost of sales. So if you take sales of 74 million, 566,170 rands, you minus 34,592,448 rands. You can see you come up with gross profit of 39,373 rands. Secondly, let's look at a gross profit margin. I said to you, gross profit margin is gross profit divided by sales. Now, if you take your calculator and you punch in 39,973,722 rands, you divide that by 74,566,170. multiply by 100, you can see you come up with a gross profit margin of 54%. Third one, net profit. We said net profit, the formula for net profit is gross profit minus operating expenses. Let's look at our net profit in this case of January 2016. Gross profit is 39,973,722 rands, and our operating expenses is 9,286,435. If you minus this operating expenses from gross profit, you'll see you come up with an amount of 30,687,287 rands, and that is your net profit. Number 4, your net profit margin. I had said net profit formula is your net profit for the period over or divide by sales. So in this case, you need to take 30,687,287 rands and divide that with 74,566,170. If you do that, you'll see it gives you a net profit margin of 28.5%. The fifth one, return on total assets. Return on total assets, you take your total assets as indicated in your assets and liability report, and you divide that by sales, which is 74,566,170, multiply by 100. Having applied this formula, you'll come up with the results of 2,277.1%. So, your calculation should show you the 5 results. It should show you the gross profit, it should show you the gross profit of 39,973,722. Secondly, it will show you the gross profit margin of 54%. Thirdly, it will show you the net profit of 30,687,287. Number 4, it should show you the net profit margin of 28.5%. Lastly, which is the fifth one, it should show you the return on assets of 2,277.1%. So those are the results that you will be getting, focusing on those in the 5 indicators that I had spoken to you about. Now, what are those indicators meaning to you? What do they mean to you? Remember, I said profitability must show positive. If it's negative, it's poor performance. If it's positive, it's positive performance. Now let's apply that and look what happens. Gross profit is positive because it's not showing a negative sign. Therefore, it means it's a good performance. Secondly, we said positive for gross profit margin. In this case, it shows positive. It's a good result. Secondly, we said it should be positive for net profit. In this case, it is positive. That is a good result. Number 4, we said it should show a positive on net profit margin. In this case, the net profit margin, it is positive. The fifth one, we said it should also show positive, and in this case it is positive. Therefore, applying the analogy that negative is poor performance, positive is good performance, we can therefore reach a conclusion that profitability of this company is good because all the indicators are negative. And that's a result of January 2016. Now, I want us to look at the results of February 2016 and also see how we are going to apply those results, which is slightly different from the previous. February 2016, it shows gross profit of 34 million. It shows us gross profit of 34,449 and 571 rands. It shows us gross profit margin of 42%. It shows us net profit of 20,167,860. It shows us the net profit margin of 17.7%. And it shows us the return on total assets of 43.7%. So, using the same analogy we did for January 2016, we reach the same conclusion in all 5 areas. In all 5 areas, the performance is good because it's positive. However, applying the second analogy in your steps of analysis, which is comparison, let's look when we compare. In this instance, what are we coming up with? First, let's compare our gross profit. When we compare our gross profit, we'll have to compare our gross profit of February 2016 and gross profit of January 2016. When you compare the two, you can see the gross profit of January is higher than the gross profit of February. When you do the comparison now, you can see it doesn't show you a good picture because it gives you a negative sign, which means the gross profit is declining. Secondly, let us do the same for gross profit margin. If you do the same on gross profit margin, you can see for February you had the gross profit margin of 42%. For January, you had a gross profit margin of 54%. Again, when you compare the two, you can see there is a drop, which is a negative. Again, because it's a negative, it's not good performance. The same with net profit. You can see your net profit for the period is 20,167 and 86 rand. For January is 29,520 and 81 rand. Again, you can see a decline between the two. When you compare this and this, you can see there is a decline, and the decline is negative. Net profit, same. Net profit margin of February 2016 shows 17.7%. Net profit of January 2016, it shows 28.5%. When you compare the two again, you can see that you are having a decline of 11%. Again, because that is a negative, it shows poor performance. Same with return on total assets. January you had the result showing 2,277.1%, and in February you are showing 43.7%. Again, a decline. A decline of 2,234%. Let's just stop there. When we looked at February 2016, you could see that all the indicators on their own, without being compared, they show positive results. So what does it mean? It means you are still sustainable for that period because all your indicators are positive. However, when you compare the two, they all give you negative performance. That suggests, because you are comparing one period, which is you are comparing January and February. Now comparing these two, then you come up with the results that you are negative, and being negative, that now means growth of your company is at risk. That means going forward at this rate, you are running a risk that as much as you are profitable and sustainable for February, you are running a risk that if you continue in this pace, you may end up being in the negative and be in an unsustainable situation. Now the beauty there is that it has given you, if you follow our 6 steps, you choose your technique, the results of your technique, you compare. If you compare already at that point, you know that you got to do something. You know you got to take a decision to do something so that you can have better results from March 2016 going forward. Let's suppose in this instance, the business owner has followed the 6 steps and has agreed that he indeed is at risk that going forward he may not be sustainable and he may not be growing. Let's for all intents and purposes, he has decided to take certain actions. One, let's suppose he has decided to increase the sales. He has decided to market the company aggressively. That's a first decision that he has taken. The second decision, let's suppose he has decided to reduce the costs. Thirdly, let's suppose he has decided to reduce his operating expense. So what a business owner will have said, let me increase my sales, let me reduce my costs, let me reduce my operating expenses. Then let's see what happened for the month of March 2016. Boom. He has taken decision to increase sales. He has been successful because in February he had sales of 82 million. However, in March he's now got sales of 90 million 225 and 66 rands. So therefore that means his decision is applied and now successful. Good point. Second, he has decided to reduce cost. Let's see what happens. No. What he has done, he has not reduced the cost. He's instead increased the costs. Another sign of worry. Thirdly, let's look. He also has decided to decrease the operating expenses. Let's see what he's done. No, he instead have increased the expenses. So we can see from here, of the 3 decisions, he has undertaken 1 decision successfully, which is to increase the sales. However, he didn't do so well in decreasing costs and operating expenses. Let's see what the results will show us. 1. Gross profit 37 million is positive. Gross profit margin 42%. Net profit 22,578,674. Net profit margin 18%. Return on total assets 30%. Again, same period, 1 period, all the indicators are positive. Comparatively, there we are. You can clearly see those sales that he has increased. It suggests that he's increased his sales more than he has increased. Though he had an increase in cost, he has increased his sales more than he has increased his direct cost, which is good news. There we are. His sales have shown a gross profit increase. Gross profit margin remains the same. Net profit also, it shows that he's increased his net profit. Because the net profit has increased, you can see that the net profit margin also increases. And return on total assets, when you compare the two, the return on total assets, it decreases. So what it means, of the 3 decisions that the business owner has taken, we can take comfort that that decision was able to produce good results. I'm sure this time you can begin to see the importance of working with financial reports, the importance of looking at the performance for 1 period and looking at the performance compared with the other periods, because at that stage you can clearly tell where the future of the company is. Let's look at working capital, liquidity, cash analysis. Those analyses are built around 4 items. 1 is days inventory or stock. 2 is inventory or stock turnover. 3 is debtors collection period. 4 is creditors settlement period. Let's work with the formulas on how you get into those elements of analysis. 1. The formula for days inventory or stock is made up of the following. It's inventory or stock divided by cost of sales multiplied by 365 days. That should express as days. Meaning, the higher the number of days that your stock is on hold, the not so good news is for your business. Inventory or stock turnover, the formula for that is cost of sales divided by inventory or stock. That should expressed as times. That is, the higher the number of times your stock is turning over, the good news is for your business. Debtors collection period. Debtors collection period formula is debtors divided by credit sales multiplied by 365 days. That should expressed as days. Meaning, the lower the number of days that you are collecting cash, the good news is for the business. Creditors settlement period, the formula for that is creditors divided by credit purchases multiplied by 365 days expressed as days. Meaning, when your days to settle your creditors is higher, that is good news for the business. Let's look at the example. The example will cover the period from January 2016, February 2016, and March 2016. The elements that we're going to cover is days inventory on hand, inventory stock turnover, debtors collection period, and creditors settlement period. For the period January 2016, you can see the days inventory stock on hand. It is 25 days. What it means on average the stock is on hand or it's on hold for 25 days in the warehouse or the manufacturing house of the company. Second one is the inventory stock turnover. What it means is for January, stock turns over 5 times. Debtors collection period for the month of January 2016, it means it takes 30 days before cash is collected from the debtors. Creditor settlement period for the month of January 2016, it means debtors or creditors are settled within 0 days. What this means, it means creditors are paid in cash. For us to make a deduction on the 4 elements, we need to compare those with a period, which in this case it will be February 2016. When we compare the two, in a case of days inventory on hand, you can see that in February, stock or inventory is on hand for 20 days, and for January it's for 25 days. What this means, it means your stock is moving faster in February 2016, which is good news. How do we know that stock is moving faster? Because you can see between the two periods that stock on hold or on hand is lower. That means stock doesn't stay longer in the warehouse. And that is confirmed by the speed, which is inventory stock turnover. You can see in February stock moves 7 times fast, and in January it moves only 5 times fast. So therefore we can conclude that stock is moving faster in February than it is in January. Debtors collection period. For the month of February 2016, it takes us 20 days to collect cash from the debtors. While in January 2016 it takes 30 days, meaning in January it takes longer for us to collect cash from the debtors. In February it means it takes lesser time to collect cash from the debtors. Therefore it means in February cash collection will be in a better position. Creditors settlement period. In February it took us 20 days to pay our creditors. That means we delayed our payment to the creditors by 20 days. While in January we delayed by 0 days, meaning that we have paid our creditors in cash. So for the month of January we had more cash going out of the business to pay creditors at a quicker rate, while in February we have got longer days before we could get cash out of the business to pay our creditors. So therefore our creditor settlement period for February is better than it is for January 2016. If you like, you could also make a comparison between your creditors and debtors. If you make that comparison, you will come up with a conclusion that says it took me 20 days, or it took your company 20 days to pay the creditors, while at the same time it took 20 days for the debtors to pay your company or to collect from your company. The net effect of the two, it means it's a break-even performance. For January, let's see what it gives us. For January, we waited for 30 days for our money, but we paid our people immediately. That means it's not a good situation, because we are allowing money to leave the company quicker than we are allowing money to come back to the company. March 2016 will show you your debtors collection period is 25 days compared to February of 20 days. That means the company is relapsing again, is collecting slower by 5 days. Creditor settlement for March is the same as for February. That means we have been consistent. Again, if you do the two comparisons of debtors and creditors for March 2016, the picture doesn't look very good, because you're waiting for your money for 25 days while you are paying people in 20 days, meaning that you're paying your creditors quicker. And this 4 will give you an holistic overview of how your cash, liquidity or working capital is doing. With that, I wish to thank you for the time spent in acquiring the knowledge and application of financial analysis techniques and ratios. At the same time, I wish to invite you to take on the questions wherein you'll be assessed on the knowledge acquired. But before you take on the questions, I wish to advise that you go onto your financial tools, where you will play with the examples provided in your slides to see how the numbers are coming up and how the numbers are interpreting. I thank you.